Some mixed signals for domestic growth and global markets are leading to a wide range of forecasts for 2020. A quick update on our expectations and predictions going into the new year. The rates on hold message from the Reserve Bank yesterday was no surprise following recent RBA speeches on monetary policy, including the speech from Governor Philip Lowe on so-called unconventional monetary policy, most notably quantitative easing. The surprising message on QE from Lowe, however, was that the RBA would prefer to go down to a 0.25% cash rate before resorting to QE, which makes 2 cuts more likely for 2020 than had been the case, although the level of the Australian dollar may be a larger factor on QE than the RBA have yet conceded. The Australian dollar has been helped lower by our falling interest rates, especially compared to US rates that are around 1% above ours, and this low exchange rate has proved very helpful for the Australian economy, making us more competitive. But as we get closer to the effective lower bound for cash rates, this correlation may unwind, especially with the US economy struggling from the trade wars that it initiated. Usually the exchange rate is heavily influenced by interest rate differentials, but perhaps the relative use of QE will become more influential, potentially forcing the RBA's hand, especially if the Aussie breaks out of its recent 66.5 to 69.5 cent range on the top side. One clear beneficiary of lower interest rates has been the housing market, with property prices clearly back on the ascent. And so, despite having been through the largest percentage decline peak to trough for property since the 1930s, the average house price across Australia is now slightly higher than 1 year ago. This trend is likely to continue next year thanks to cheap borrowing rates and supply versus demand dynamics. Hence, when reflecting on our predictions from the start of this year, it was good to get the soft landing for property right and the falling Australian dollar, but stocks certainly outperformed even the most bullish of forecasts, including ours. Again, helped by the cash rate moving lower than we had initially forecast. Both our stock market and the major US indices have posted fresh all-time record highs just in the last week, resulting in around 20% returns for the 2019 calendar year. But that's where the hard part starts for 2020 predictions. To what degree are stocks artificially inflated because of ultra-low interest rates? And to what degree are they ignoring the dangers of ever-increasing tariffs in the trade and technology conflicts? The glass half full view, which is consistent with RBA messaging, is that the global economy is slowing, but that some of these risks have moderated, which may justify where stocks are to a degree. And the glass half full view locally is that the recent rate cuts, tax cuts, and the rise in property values will drive a mild increase in growth in 2020. The Q3 GDP numbers out this afternoon should show a mild improvement to around 1.75%. But the pessimist's view might be that the rate cuts have helped with asset prices, but haven't yet driven consumer confidence or enough business investment. For the record, we'll lean to a glass half full view for our economy in 2020, but that does assume another RBA rate cut or two, and if our suspicion that the Aussie dollar is forming a base is right, then we can't rule out QE either, especially if the trade wars intensify further next year. And that's the market update, with best wishes for a safe and restful holiday season from Leveraged.